How is everyone doing? My name is Rob with Horizontal Land Partners HLP Fund, Gulf Coast Equity Fund. And today we're going to be looking at answering some questions about the peer groups. I had 2 strategy calls today with investment groups, and I think depending on who I'm talking to, it's who are you? What do you do? What's your differentiators? Why would we move forward, right? So I think coming back to it, America's working class, we're investing in the types of people and where they live. I talked to an operator in California today who's been invested in build-to-rent communities. He used to be with a large group that syndicated a bunch of capital, but none of them came from real estate. He liked that I was an operator and a visionary, and I looked for data analytics and used prop tech to kind of drive the direction versus just raising money and kind of gut test. So what we're going to go into today is a little bit more about that. So institutional, capital light housing, and essential land across the Southeast and Gulf Coast, the last major corridor where it's cheaper to own than rent. So we're going to go into peer groups today, and instead of me telling you, I'm going to be covering the peer groups and how they would work together. So the first group we have is land and lot development companies. That's companies like 4-Star Group, Howard Hughes Holdings, Inc., and the St. Joe Company and 5 Point Holdings. These are companies with NAICS code 237720. We have mobile home and RV REITs, which are Sun Communities, Equity Lifestyle Properties, Inc., and UMH. I actually reached out to Sun Communities today because I believe the opportunity that we have is most aligned with what their financial statements say. I could be wrong, but they are actively developing according to their financial statements. So this is kind of the group that I would say we're most closest to, which is 531190 on NAICS codes, which is lessors of other real estate property. If you look at some of these other ones, you have factory manufacturing, Cavco, and Skyline. These are manufactured home manufacturing. So manufacturing companies, 321991. Now, one thing I would say about manufacturing is that it's very, it's amazing, and it also drives job growth. So if you look at jobs, they come from manufacturing, they come from retail. If you look at the highest price per square foot, it comes from retail, manufacturing, logistics, and more like, I would say, like hospital, right? So that's another one. Then you have factory built manufacturing, Berkshire, vertically integrated marketing, manufacturing, retail, finance, and land development, which I don't know if they're in 321991, but that Clayton Homes is one of their best ones. You have home builders, single family home builders, which are 236117 on the NAICS codes, which is new housing for sale builders. You have industrial REITs, which is Prologis, Rex 4 Industrial Realty, Digital Realty Trust, Inc., Equinox. These are data centers and industrial REITs, which again, lessors of non-residential buildings except mini warehouses. So if you look at the market caps, this is probably the position that we're going to be in, the 531s. 531 would be our fund, which is lessors of real estate property, combined with a few others a little bit. And then you have infrastructure, Brookfield Infrastructure Partners, which is natural gas transmission and diversified infrastructure, 486210. And then you have Clearway Energy, which is renewables, 221118, other electric power generation, which is renewables. And the types of assets that we're after, we can do all of these in one without having to do the manufacturing. So if you look at this peer group, this is, I would say, a good representation. And we're going to go into these a little bit, and I'm going to talk about the strengths and weaknesses of each. So we're going to start with some of the home building. 4-Star is owned and operated by, oh wow, I just got a headache. By one of the largest home builders, which is DR Horton. So they own them. So their 4-Star is a subsidiary of DR. They own the controlling interest of them. What they are is they do land subdivision, B2B. So they develop them, they hold the debt, and then they spin it off so that D.R. Horton can stay capital light. Lennar has done the same thing this year. They spun off their land division and made it into it. But these are the cash cows. This is what generates the returns for the larger one, but it's capital intensive. So if we look at the market caps of some of these, you can see it's 1 to 5 billion of these land devcos. And traditionally, they have a really stable pipeline, but there's not really a lot of income to generating these until they exit. So they're driven by a parent company, which means it's a pass-through entity. You know, the revenue is a pass-through subsidiary. I'm not sure where they spun them off, but you can see the debt that they carry in net cash, and then the enterprise value, the revenue, TTM, net margin, and leverage ratio, net debt to market cap, which is one of it. This is asset light lot development, moderate leverage, magnifies IRR on delivered lots. But again, their parent company is driven by that. You can read some of their financial reports. If we look at what they're trading at, it would be this. You can see that they're on the New York Stock Exchange, 4-star group. Their market cap, their PE ratio, earnings per share. And then I like to read some of these. Millrose Properties offers 9% yield potential gains as land bank to home builders. So Millrose just spun off, but you still have to create a transaction and you're still reliant on that. They're not able to generate their own returns. If home builders pull back, if interest rates pull back, then these firms are just stuck and they can sit, right? 4-star group to release earnings. 4-star group shareholders notch 30% CAGR over 3 years. Strong growth. There's a lot of money in this, and it's because the land delta is the greatest and fastest delta in real estate is through land entitlement. You can look at the 3-year return. 4-star compared to the S&P, it's double. The 5-year return, 4-stars returned a little bit less, but again, I think it depends on strategy. There's a lot of independent driving forces behind that. If we go to, where was the other one? If we look at Howard Hughes Corp, master plan communities and mixed use developer. Now, MPCs are the future of development. It's diversifying risk by spreading it through, and they're also extremely efficient. So MPCs have the largest presence in Texas and Florida, which is why we try to push those as the major one. And there's a lot of interest from institutions from this because it's very diversified. The largest buyers of lots in these are Lennar and D.R. Horton right now, along with a bunch of others. It depends on balance sheet and commitments. When I was in Ohio, we could not get individual builders to commit to more than 50 to 100 units in one subdivision in one area at once. So the answer to that is by creating an MPC and selling out entry-level points along with amenities too. So it's more than just land infrastructure. It would be master plan community developers. So you take larger positions, and I would say that 4-star hasn't done this as much. Howard Hughes has done very well with this, and there's a lot of interest from some of these other ones. You see Hines in a similar type environment, depending on it. If you buy the entire communities, you own them. So there's a lot of interest in master plan communities, which is what my background is in. That's in land development. That's in land-backed bonds. So land divisions and MPC. So whereas this one is for single lot developer, these MPCs are there's been larger ones. These are 10-year, 15-year positions sometimes. MPCs do not get the velocity up in Ohio. The last one that was done by Nationwide Realty Investors, but the entry points were not low enough, and they weren't the best at it. But there's a lot of interest in joint ventures with master plan communities. So if you look at this, the market cap is $4.8 billion, net debt, enterprise value, MPC developer, project level, leverage common, EV sensitive to land cycles. So again, they don't have a way to actually make money other than exiting, which is tough. There's not like a fixed return that you're getting there. If you look at Howard Hughes, it trades at $80 a share. You could see their market cap, $4.81 billion. And then you could say billionaire Bill Ackman's big bet. What you need to know is is now the time to put Howard Hughes Holdings on your watch list. Just flash golden cross signal. Do you buy? A voice for Israel? And then you look through here. Billionaire Bill Ackman has 55% of his hedge funds, $15 billion portfolio held in just 3 specific. Howard Hughes announces dates and times for third quarter. Micron upgraded. Klarna initiated Wall Street's top analyst calls. Discovering Gen X. This is one of the best. This is New York Stock Exchange, right? So these are large corporations. You can see the 3-year yield, 45%. It's been behind the S&P. And that's because a lot of theirs, you can see the yield return 5% versus the S&P. So holding incomes, if you compare this, if you compare Howard Hughes to Forestar is constantly trading, and they're selling individually titled lots, which is one of the strategies we started to look at. It was taking raw land and subdividing it not only into master plan communities but also into lots, so that you can sell and exit at a much faster pace. People, the group's firms are driven by income. So I would say that one of the major problems with these guys is they can't exit fast enough because they haven't created the single parcel exits like other types of firms. Net income, diluted earnings per share, total cash, total debt to equity, levered free cash flow, enterprise value. So you kind of go through this. So what I say that I think the right thing they're doing is MPCs, master plan communities, but the way they're doing it is not wrong. Here at Gulf Coast Equity Fund, our focus is on looking and benchmarking against a lot of these. Howard Hughes has major positions in Texas and across the U.S. We wouldn't take a position outside of Florida or Texas for something like this. But let's keep moving. Now we look at the St. Joe Company, which says Florida Master Plan Communities and a land bank. They're also in land and subdivisions. Their market cap, $2.84 billion. Lower cash flows, value tied to entitlements. So the upside that they have, if you just did this, you're risking the upside when it comes to you're not having the cash flow unless you break them up like Forestar is. Forestar is the most efficient at it because they know how to do it, but they still barely represent even 1% of new homes in Ohio. There's a lot of their focus is on higher end properties, which their average lots around 90,000. Land is typically it's never more than 20%. Typically it's between 12 and 18% of exit price on the homes. So they're not really in the right. So they can't enter a lot of markets that we can. So they tend to be on the higher end of it. Okay. If we look at their positions here, they're also on the New York Stock Exchange. St. Joe Company's $50 a share. Let's read the news. Fair Home Fund strategic moves. The St. Joe sees a 2% minus portfolio impact. Announced a dividend. Earnings per share by the dip. 3-year returns. You can see it's still a little bit behind the S&P. And it's almost equivalent. So these are very stable REITs. I guess, I don't know if I would call this a REIT. It's more of a business. It's a very active business that doesn't have it has a lot of downside because it's cyclical, right? And you could see the returns. The profit margins are pretty good. The revenue, net income. So that's kind of the first group. I think you guys kind of have an understanding. Moving on to the next group, it's what I believe to be the best asset class to be in, which is the lessors of other real property. And this is manufactured housing, RV parks, and marinas. If you read the financial statements of these firms, they're using RVs and temporary to move them into manufacturers. So as people start coming down and they like it, they have both. They share amenities. There's other ways to make money because people want to go to fitness centers and they want to shop and they want to go to coffees. So if you look at master plan communities, a lot of times the land developers or the major developers own some of those assets, and they have the income. So let's look at Sun Communities, who I believe to be the best. So they have a market cap of $16 billion, total debt of $7 billion, cash $1.4 billion, net debt $5.8 billion, enterprise value $22 billion. And then you can get to their, this is a REIT, higher fixed assets, net debt is meaningful, enterprise value is greater than market cap due to debt. FFO driven. Let's look at their Sun Communities. Here you go. $124 a share. Previous close. Days trading ranges. Sun International, first half 2025 earnings call. If you invested $10K in Sun Communities 10 years ago, how much would it be now? Let's take a look. If you bought the company stock traded at 63 10 years ago, 10,000, you could have bought it approximately 158. Currently, the shares trade at 130, meaning your investment value could have grown to 20,000 from stock price appreciation alone. However, they also paid dividends during those 10 years. It was 3% over the last 10 years. It's paid about $38 in dividends per share, which means you could have 6,000. Summing up, 254,000 and 145,000. We end up with a final value, which is 26,000. This is how much you could have had. That means that the total. What could the next 10 years? Sun Community has a consensus rating of neutral and a price target of 139. The company announced Q2 earnings of that. We are pleased to report strong second quarter results. It is also one of our pivotal closes in history as we have completed the previously announced sale of Safe Harbor Marinas and repositioned Sun as a pure play owner and operator of manufactured housing and RV communities with a best-in-class balance sheet, which is exactly where we're headed. They exited marinas. Now what they don't own is energy or infrastructure, which we'll get to down here. And that's one of the problems with them. I would also say they don't own I think they could round that out a little bit better and say our focus is on generating larger communities where we can also partner with home builders and enter the market earlier on, close to tier 1 metros in Texas and Florida. That's the way that I would say it, but this is a great sum up of what they're going through. If we hit the back button here and I go back to where they're at, let's see here. Sun Communities, investors shouldn't overlook impressive returns on capital. These guys are stable. Sun Communities announces a new $2 billion revolving credit facility. Why? Why would they need that? The new facility permits borrowing in USD, which margins 0 to 1.4. It has maturity date of 2030. This comes after Charles D. Schwab Young, Sun Communities Inc., new CEO, was given a $1 million stock reward as a perk for joining. By supporting continued operations, possible acquisitions, and expansion plans through its portfolio of manufactured home and RV communities, the new credit arrangement increases the company's financial flexibility. They are getting ready to develop. They own 501 developed properties with around 174,000 units throughout U.S., Canada, and U.K. One of the best stocks to buy. While we acknowledge the potential of SUI as an investment, we believe certain AI stocks offer greater upside potential and carry less downside. Extremely undervalued AI. I don't know what that is. I think it's under that. So that might be an advertisement. I think it is. So looking through that, REITs, right, being classified as a REIT or as a fund that owns and operates manufacturing home parks and the energy systems that support that mean you don't need grants. Now, if you go to Sun Communities, let me see here, acquisition criteria. I'll show you what makes it wrong, in my opinion. Some Sun Communities, 100 pads. Okay, it's hard to say, but when we look today, actually I do want to find it. Sun Communities development criteria. Now, this would be under acquisition, and a lot of firms don't separate acquisitions from development or strategic partnerships. they wouldn't be acquiring a deal from us, right? We're an operator that wants to work with Sun Communities. Manufactured home parks, typically 100 plus sites with lots big enough for double wides. So that's their criteria. That means frontages would probably be at least, that's 28, probably 32 feet wide. RV resorts of at least 150 near tourism destinations and within 3 hours of major population centers. This matches a piece of land we found in Henderson County today. Land parcels for new mobile homes and RV parks, 50 plus developable acres preferred. Public utilities access preferred, close to population and jobs, or tourism centric. Deal structures: Sun can do all cash, tax deferred stock, or combinations. In 2025, sold Safe Harbor Marinas and is now a pure play mobile home park and RV operator. Don't pitch marinas. Acquisitions page. This is what I'm going to show you. Okay. Premier owner and operator of manufactured housing communities and RV resorts. Our company is recognized for having the nation's most attractive 1933 with 24 communities, and since we've grown to 650. From 2011 to present, we have successfully acquired over 300 properties with a transaction value over that. How we grow. Here we go. Mobile home communities of, now we're doing both. We're doing land and we're combining both of these. Large enough lots to accommodate double wide homes or 100 plus sites. For that, you would probably need at least 8 units an acre. That would be 80 acres, depending on the densities that you're pushing there. They might have a lower density if they have double wides. Traditionally, I would say the right densities are around 12 an acre. So for this one, they're asking for about 80 acres. RV communities are higher density. And so you're going to see 150 sites. You could probably get almost 20 per acre. So you would probably want at least 10 acres for that. Near popular or within 3 hours of population centers. Our piece of land doubles that. And then for land parcels, 50 plus developable acres preferred. Access to public utilities preferred. What they don't realize is how much money there is in energy. And we were looking at deals in Florida for a long time, but it's a regulated energy market. It really should be taken down in an antitrust, lawsuit, in my opinion, by the parent company. They control the utilities board, but that's besides the point. They have access to public utilities, proximity to population, job centers for residential developments, tourism-centric destinations with idyllic natural settings for resort developments. Now, if you go to Henderson County, Texas, this is our number one because it's close to Dallas. You could see there's already this area right in here between the Texas Triangle is where we're focused. Waco, basically in here. But one of the problems is that some of these have stricter development standards compared to Henderson. And if you go over one county, you have a lot more land. So you can already see that there's water parks over here at the villages. So you can see there's already some types of communities like this. You can see Tyler, Texas. So we're in between Dallas and East Texas. There's already home builders in here. And the land that we're identifying is right in this county around here, northwest of Athens, close to Eustis. There's 100-acre sites for under $1 million, which is an extreme low basis. The only other place we've been able to find that kind of deals is in North Florida, and there's no economies, right? It's tougher to get that. So we really like this. The other places that I'd say is we like in here for slower development, but over here, if you read the zoning codes, it's much more favorable to development. So that's one of the reasons why we really like it. So if I could pick who I would be working with, it would be Sun Communities because of their alignment, and they are ready to grow. They're paying a dividend. Here's the returns. Now, I don't think you've seen them be as active. So far, we've seen 4-star as the best 3-year return because they're exiting and they're really transactional. They're able to exit on it. So if I was to show you one other development, this was a development back in the 70s. It was Rotunda Community Park and Reserve. And this is the way that you lay it out. They did all of these. They developed all of them to be waterfront. This is one of the best developments that we've seen, and there's thousands, and everybody owns their individual ones. So what is Rotunda West And how many acres does it sit on? It's probably 20,000 acres. Master plan community, so MPC is what we talked about, and that was way long ago. 23 miles of waterways. So what you see with the villages is taking a large land position and then continuing to go about it in that direction. So one of the best unincorporated deed-restricted plan community in Charlotte County, Florida. This is the best, one of the best. How long did it take to sell out Rotunda West? They sold 10,000 acres of it almost immediately. So the way, if you look at the best real estate deals in history, this is one of them. Babcock Ranch is one of them. And they were done by large REITs that master plan developed them and everything. So remember, 4-star that we're seeing is still the highest return. And we can ask why. On the 3-year, why are they so efficient? That's enough time for them to cycle. Is somewhat counterintuitive when you look at the fundamentals. Over the last 3 years, it's risen by 120%. During the most recent quarter, its revenue grew 23% year over year. The company has a large backlog, is owned and controlled, 102,000 lots, 25,000 which were under contract. It's well positioned for residential lot development, entitlement, land conversion, finished lots sold to homebuilders, which has been the supply constraint tailwind according to some. Why it's beaten: backlog and visibility. The massive contract backlog of billions gives investors confidence in future revenue. Supply side tailwinds. In the residential lot development sector, land entitlement and finished lot supply is a bottleneck. 4-star leverages that. Undervalued. That's true. Most of these firms are undervalued. Some metrics show the company trades at lower multiples. The company has strong relationships with D.R. Horton, which is the largest home builder. Investor sentiment. Although revenue grew, net income are declining. Why it looks. Pulling it together, the stock beat the others because investors are valuing forward-looking metrics, backlog growth potential, and supply more than current earnings or margin metrics. Future value story rather than today's profitability. So within the REIT sector, this shows that forward-looking entities that have supply-side economics are going to outperform their peer groups that don't. If I just own and I don't have the business side of master plan community development, I'm not going anywhere. Let's keep going down our list. Okay, let's look at Equity Lifestyle Properties, who is manufactured housing and RV parks as well. Lessors of other real estate property. And you can see their market cap is $12 billion. Their debt, $3 billion. Cash, very little. Net debt, and then enterprise value. REIT, stable cash flow, high leverage, typical for REIT model. So a lot of REITs that don't have the active arm of land development are going to kick cash out, and they're stable, but they don't have the upside or forward-looking metrics that groups like 4-star have because they've figured out land entitlements and development. The land delta is more than when you buy land at the right price, the deltas are great. So if I bought a pre-entitled piece of land and turned it into 100 acres isn't large enough for a master plan community. It's more like 500 acres. But if you start taking positions and showing what you're doing, you're going to do well. So let's take a look here. This is also traded on the New York Stock Exchange. Equity Lifestyle Properties. $12 billion. Let's see here. Let's look at their performance. 3-year return, 17%. S&P, 80%. ELS, 15%. S&P, 96%. And on the 1 year. So remember, if you are just owning and operating mobile home parks, you're not going anywhere. But if you have the active business side, like the S&P 500, you're going to kick much higher returns. So when you introduce a business into a REIT and you combine their strategies, your returns will be much higher because you have forward-looking performance metrics that some of these other firms don't have. So I think overall you can start to see a pattern emerging where the combination of income and entitlement and holding a REIT that also entitles is the future of or maximizes enterprise value, which is what our strategy focuses on, a hybrid. If we look at UMH, who owns several down here, they call them small. They are also Midwest and Sun Belt, lessors of other property. Small cap REIT, leverage meaningful relative to market cap. Let's take a look. If we look at how they have performed, a lot of these are just from news articles and presses. They're not really getting a lot of coverage. UMX expands its footprint in Georgia, acquires Albany communities. So they're buying communities. They want to own communities and buy stabilized values. So someone like this, if we're a REIT that does, if I operate with Sunrise and we carve out 150 at a time of different types, here's the single wide, here's the double wide. They can sell some of those communities and exit, plus they can operate. So there are buyers for these, but they're not in development. Sunrise is more in development, and some of these other firms are less in development. So this is more of a stabilized holder. Again, you're going to see that they're stable, but they still underperform the S&P, and they're also traded on the New York Stock Exchange. So the 3-year returns are stable, but they have not done what some of the other firms have done that are in entitlements. So you're starting to see that REITs that just buy and hold, they're great and they're stable, but they still underperform their peer groups that introduce a transactional side of the business, which you're going to start seeing much higher multiples when we get into them. Okay. Cavco. Cavco is in manufacturing, and Cavco is one of the partners that they own the factories. I believe that them and Skyline allow for white labeling manufacturing, which means I can make Texas mobile home direct or manufactured houses direct or Dallas, a local trade name and brand it and be the manufacturer for $900 license. And that means I pull from their factory and I purchase in bulk. Where they enter the market, they're one of the big three besides Skyline, and we're going to take a look here. Now, manufacturing has always been one of the best industries to be in. Manufacturer net cash returns largely unlevered at corporate level. They are traded on the NASDAQ. Their stock price is $500 per share. Market cap, $5 billion. And let's go down here and take a look at their performance. So you see, when we introduce manufacturing, we outperform the S&P, not only on the 3-year or the 1-year, but also the 5-year. So Cavco, who doesn't own parks, they own factories, has a higher return than the S&P on the 3-year. It has 170, and on the 5-year, it has 224. And if we compare it to 4-star, there's 150. They're not selling. Here's 150, and theirs was 170. So they're outperforming land developers, right? And when you combine both, you add a double leverage. So if you look at the return cycles of Cavco, 170% returns in 3-year historically on a performance, that's a trailing volume. It shows that manufacturing is going to do it. Let's read the headlines. There are none, which is insane. So, and this is their competitors, Cavco, Sky. These 3 companies control 90% of the market. And they say they're in residential construction. So this is in building products. So these are compartmentalized building products, but they're selling a finished good direct to consumer in a way. Champion Homes entered the market. They bought $300 million to be able to compete with Cavco. They have massive backing. These companies have massive, and you can see some of their peer group. This is probably the closest. Cavco Industries, Champion Homes, Installed Building Products, Legacy Housing Corp., and Meritage Homes are probably the closest, except what they don't take into account is the new future, which is media, marketing, and that if you look at Champion Homes, recently Champion Homes and Champion Retail Housing subsidiaries of Skyline today announced the closing of a previously announced acquisition of Regional Enterprises and related companies. Mark Yost, Skyline Champions achieve. We believe Regional Homes is an excellent strategic fit. And what they bought was market positioning as a leading provider of attainable housing solutions by expanding our captive retail and manufacturing distribution in this large region. So they are following the direction of Clayton, which is full integration. And Clayton is doing very well because they have a great land development, but they don't have the reach that some of these other firms have, like the positions in manufacturing. So that's what happened first, right? Like a new factory can generate $200 million in income, and it costs $50 million to build, and it makes 300 jobs. We've looked at Clayton's new factories, they just built one in Arkansas. In coordination with the closing, Skyline is pleased to announce that Heath Jenkins will serve as the president. We are fortunate to add Heath in the Skyline Champion team. He brings years of experience in retail experience and strong leadership. The purchase was $313 million net of cash acquired plus assumed debt, primarily related to inventory floor plan liabilities of $93 million. Skyline, and then we can see about Regional. Headquartered in Mississippi, which 1 in 3 homes in Mississippi is a mobile home or manufactured home. It's a manufactured and modular housing company with 1,200 employees, 3 manufacturing facilities, and 43 retail locations throughout the Southeast. Regional Homes is the 4th largest company in the industry. So these companies keep rolling them up and acquiring them. So when something is really good, they take it. Since its founding in 2006, Regional Homes has sold over 30,000 homes and has built a reputation of exemplary service. This is one of the best. And if you look at these, there's already companies like this in Texas already. Texas has the number one most, 18,000 manufactured homes sell a year, 1,500 a month. Regional Homes also maintains strong relationships with federal and state agencies by providing disaster relief programs in Texas, Mississippi, Florida, Alabama, and Louisiana. That's the Gulf Coast. So if you look at this acquisition last year or 2 years ago, it's the direction the industry is headed, right? With a distinguished company culture, Regional Homes strikes a balance of teamwork, competitive, whatever. It's super corporate, but this will show you why Skyline is an amazing company to look at. Sun Communities as well as Cavco. So Skyline as well. Skyline is a manufacturer that just bought, and now, so if I wanted to go and buy from them, it's hard for me to do that anymore because they just made a $300 million acquisition of another company, manufactured home manufacturing. So if I was to pick where to enter, it's build a factory. There's already massive manufacturing opportunities. There's large manufacturing bases in pharmaceuticals in the county that we just talked about, which is one of the big problems we don't see in Florida. The job creations are manufacturing. I'm from a manufacturing heavy state as well in Ohio. So I grew up watching the auto industry. But when I moved to Columbus for the last 10 years before I moved to Miami, that's what we saw. So Berkshire Hathaway, hard to prove a point. I don't think they have a link. Because it's a portfolio company, but you can see Berkshire, right? So Berkshire has always been in railroads and infrastructure. If you look at Berkshire's investment thesis, it's manufacturing, logistics, infrastructure, energy, housing, and manufacturing combined. So Berkshire's strategy, again, we can look at how they've performed. I think they're private, though. Here you go. They still underperform the market because they don't take risk. So they've done very well. They are, he does a really good job of benchmarking against that and kicking it out, but he's not, it's not performing like the other ones are because they don't take risk. They only buy more mature. So the potential partners for us aren't companies that don't take risk. You have to, or you're not going to make it. If you look at the home builders now, let's take a look at DR. Now, DR in my market they're in NAICS codes. They're entry level. I wouldn't even call them entry level because they don't even drop below 330. In our markets, they have not figured it out. So I would not argue that neither them, Lennar, or Pulte are entry level, or MI Homes either. NVR isn't either. It's really like Ryan Homes because of the entry points. If you look at just Henderson County, new construction homes, this is where we're looking at. Homes in the 200s. The average home is around 360 in the United States, and I think a lot of these firms are struggling to get into the entry point. This is Texas. If we look at Texas, East Texas, right? And we look a little bit closer around Henderson County, you can see who's in this market, which is National Home Corp, $200,000. This is what they're building, ranch slab on grade. This is exactly what Arbor Homes builds. This is also this is a cross mod. So this looks identical to what DR is building. DR still builds stick built, not production built. So, and then you also see this home. This is a manufacturer. This is a 1,700 square feet. You see 4-bed. This is a DR Horton community, and they can enter the market at $249,000. At $6,000, that's about 8 units an acre. So depending on the styles that you're after, I think that's what you're looking at Chandler, Texas. So these are the builders that are in the markets where we're at. They're already active. This is a DR Horton style product as well. Let's take a look. Oh, no, that's National Home Corp. They're using the same pictures. These are all by the same ones. You know, these pictures are reused by all the builders. National Home Corp. To build affordable homes, privately held in Denver. National Housing Corp of Hawaii. America's affordable builder with 75 years, building over 1,000 homes and donating. So this is the type. Meet the biggest mover on the 2025 100. Climbing to number 78 after closing 700 houses because they're scaling out. Right? So you could see the affordable housing jumped 70 spots in 1 year, climbing to number 78 after closing 747 homes. And how? It's by getting into land development and taking larger land positions and getting backing. So this is the way that you grow. And why become a home builder when you can enter and operate under all of them or under subsidiaries or exit to the. So this is National Home Corp is in the markets where we are looking at, and we are first market movers, and so are they. I would say that they're doing an amazing job by looking at that, and so is DR. DR has always been a first market mover as well, but they do it through DR, through 4-star. So, NVR, let's look at DR's performance. They are cleaning up. They are the number one home builder and have gone past MI faster because they take positions in very rural areas where there's less entitlement friction. But they also take agricultural land and tap into public utilities. If they did larger master plan communities, they could develop their own utility systems. Let's take a look at their returns. So their peer group is Lennar Corp, Toll Brothers, Pulte, and KB Homes. Now, they're all in residential construction, which is an amazing market to be a part of. The 3-year is 134%. The 5-year is 127%, but the 1 year they haven't done as well as the S&P. So if you look at their land side, it's done much better. That's why they took a position in 4-star, so they can push it. A lot of the returns, it's because they don't have the consistency. When you're in residential land development, I've never seen the interest ever until I got into land development and got out of just building houses, and I kind of absorbed that part of it. But you can see they're still underperforming their subsidiary. Millrose Properties will never be able to compete with 4-star. Earnings calls. I think one of the things you see with DR is that they have trouble in that lower price band, which is where the velocity is at. And if you look at DR Horton and if you look at NVR and Clayton, and not just NVR, but Ryan Homes, they are first market movers in markets that are compressed like Dayton. But if you talk to their home groups in Dayton, one of the things they'll say is that they had trouble selling communities because of credit. So it's better to rent those than sell them. So it still comes down to who is the end user. And if you don't have an end user, what a lot of these companies are doing is using rate buy downs to push the debt, pass on debt, and make sure it fits in a box, right? So the use of debt to pass through and exit is an amazing tool, and America loves debt. Okay. Let's take a look at Lennar really quick because Lennar builder, strong cash flow, conservative leverage. Lennar's out of Miami. They have like a 75% market share in Miami. And let's take a look at how they've performed. Warren Buffett just $1 billion of these 3 stocks. That's exactly right. He did own DR, but he sold it. I wonder if he owns a part of this now too. He probably has exposure through other companies like this. Warren Buffett stocks to own forever. Pulte's Q3. Here's the peer group. So Lennar is on the 1 year is down. The 3 year it is even. And the 5 year it's about even as well. So it's a very stable home builder that does a great job. I think they also are in the upper range of it. They have no one. Like where I'm back in Ohio, nobody wants Lennar to come in. They tried to enter the market, but there's like friction, especially from DR Horton because DR Horton owns the market in Columbus, Ohio. So there was no one in Columbus, and then DR Horton came in and became number one because of the velocity. But if you actually look at who is the velocity, it's Arbor Homes. And Arbor Homes and DR are doing a lot together. And the newest communities are more Arbor Homes, which they're in around the 200 to 250 price range. So you can have a diversified entry point, and you can see their comparison. Hovanian Enterprises, they used to do build on your lot. I tore down a couple homes for them in Central Ohio that were ground leases, which is insane. They built them in 2008, but they still haven't been able to enter the market like some of the other firms have. Yep, Pulte. Pulte bought Centex, enter a market. They're not really an operator. They just entered it. So if you look at the roll-ups, creating the value is the secret. Let's see what we got here. I'm excited to look at NVR. I'm going to skip Pulte. I'll look at Pulte too. So NVR, $7,000. Residential construction, consumer cyclical. Following a recent share pullback, why NVR's appointment to the board, one cash producing stock with existing. Let's look at theirs. So they're also down on the 1 year. They're beating the S&P on the 3 year, and they're even with the S&P on the 5 year. So what you're seeing is that home builders are not outproducing it. If you compare them to, let's see where Cavco was. Cavco on the 1 year is 35% return. They're beating Cavco across the board is beating the S&P 500 year to date, the 1 year return, the 3 year return, and the 5 year return. And it's almost double them in every single one. And that is because it's the right combination. So if you combine what they do with land and lot development, along with an asset-light capital approach, you're going to get closer to what you're looking at. If you look at why, let's just, since we're on here, why are Cavco's higher than? One's in manufacturing and one, it's because one does it in a factory and the other one doesn't. Higher than this. Let me paste both. So if we put in Cavco and we benchmark it against this one, it'll do a quick analysis and tell us why. This is the amazing part of AI. Large language models as well. Let's unpack why Cavco has outperformed Forestar, even though both are in the housing ecosystem. It's a manufacturer and retailer of finished manufactured homes, direct home sales, retail, and wholesale. High operating leverage, but recurring demand from affordability crisis. So they are entering the market at the sweet spot, which is the lower you enter, the better you'll do. Forestar Group is a land and lot developer, sale of finished residential lots, high cyclicality, dependent on builder demand, land entitlement. Cavco sells homes to end users and gets cash flow from sales, while Forestar sells dirt, cash flow from lot sales. Secular tailwinds are stronger and more stable. Manufactured housing demand. The U.S. has a record affordability gap. Cavco sits right in the middle of that. It benefits from permanent demand for low-cost housing, especially from Sun, Equity, Lifestyle, and UMH. Policy, FHA, and HUD support. Post-2023, regulatory momentum has made manufactured homes easier to finance and zone. Cavco captures that upside directly. Cavco owns factories, distribution, and now retail channels through American Homestar acquisition in 2025, giving it pricing powers and better margin capture than pure land developers. Replacement cost advantage. In many markets, a Cavco unit can be delivered for $100K versus a $350,000 medium. Result, strong compounding earnings per share growth. 24 to 26%, 5-year, 225%, 3-year, 170%. Versus its lumpier. Profitability, Cavco net margin 9%, Forestar 12%. Return on equity 17%, Forestar is 10%. Debt to equity 3%, Forestar is much higher. Free cash flow positive and steady, Forestar is higher in volatility. Cavco runs asset-light manufacturing, plants and inventory, which are driven by orders and deliveries in 8 weeks. So Cavco can deliver in 8 weeks. Versus, and so does Ryan Homes by not buying and owning land. Forestar does 50 to 60% free cash flow. So Cavco runs, the market rewards Cavco's higher return on equity and cleaner balance sheet. PE is 25.6, Forestar is 8 to 9. Price to sales is 2.3, Forestar is 1.1. The beta 1.23, Forestar is 1.6. Ownership base, mostly institutions, long-term funds. Forestar is mixed retail and builder link. So this is owned by more Wall Street firms. Cavco's multiple is higher because investors price in durable growth and pricing powers. Forestar's PE reflects risk, dependence on deordinate, and less consistent cash generation, which is true. That's what we talked about some of the earlier ones. Despite the higher multiple, Cavco kept outperforming because EPS growth justified it. Integration flywheel, which is what we talk about, the flywheel model. Acquired American Homestar, added 18 retail stores and 2 factories. Expanding modular capabilities, targets commercial and workforce housing segments, but they don't do development, which means if you control the development pipeline and you own this you don't have to work with Cavco. Digital financing channels, integrating financing arms to reduce friction. Vertically integrated. Exposure to affordable housing megatrend. Cavco has it, Forestar doesn't. Neither does DR Horton. Earnings consistency, Cavco has it, Forestar doesn't. Leverage and risk is low, Forestar's is high. Vertical integration, Cavco has it, Forestar doesn't. Margin durability, Cavco has it, Forestar doesn't. Market narrative, housing affordability play, they have it, Forestar doesn't. 3-year total, 170%, 150% compared to 150%. Cavco's outperformance comes from structural tailwinds in affordable housing. Manufactured homes are counter-cyclical. Superior capital efficiency, low debt, high return on equity, steady cash. Vertical integration and acquisitions that extend margin capture. An investor narrative that sees Cavco as a long-term compounder. Now you can take those, if you look at Sun communities, or if you look at the highest performing parts of these, or of the peer groups, you'll see that there's nothing better. We just came from, this was NVR. And they're going to be down because they don't have that either. they're up and down. So the 1 year, like they beat all of those over and over. So if you're looking at where do I enter, the best performing that we've seen so far is a Cavco entry point, which means you would be in 321911, which is manufactured home manufacturing, and you would want to be in the operators 531190. So the combination of these four firms, mobile home and RV REITs plus manufacturing, is exactly what we're after. And where do we go deep? And land entitlement, right in here. Where do we go deep? It's in Texas, where these companies also have their largest manufacturing and the largest positions are also in Texas. When we look at Prologis, we can look at a little bit of these. Prologis is going to be really low. Industrial REIT, heavy asset base, debt magnifies returns on stabilized NOI. You can see that we're going to look at the consistency. So the industrial sector has been amazing, but they don't have the ability to beat the S&P. So of the REITs, theirs is great. Being the landlord of someone that's in logistics, who is their largest holders, you're always going to be in the greens, and you're not going to have that. So it's extremely stable, and that's what's allowed them to grow so large, which you could see their position. Their market cap is $147 billion. If you look at, and this is the same as some of the other REITs where I'm from, there's some big REITs, Vanguard, I believe, Van Trust. There's another big one in Columbus because there's so much industrial in Columbus where I'm going from. But I would say the newest one is close to like Anduril. Anduril was a disruptor of the year, and they are in manufacturing, but they don't own their own facilities. Let's look at this one. Let's just look at their performance. We're just looking at performances now. Same thing, green across the board, 16%, 1%. They're down on the 3 year and the 5 years. So again, we don't want to benchmark against underperformers. Let's look at data center REITs. This is Equinox, who we reached out to a long time ago. They're global. Let's see how they've done. Not so good. So they're still down on the 1 year, and they're stable. Their pace, they can't beat the S&P 500. They're traded on the NASDAQ. Let's take a look at, let's see if there's any others. Brookfield Infrastructure. I think you'll see the same one. Stable, right? So from what I've seen, the highest performing and most stable is what Clayton Properties has done, Clearway Energy Inc., Yieldco, project level distributions. This is energy and infrastructure, but these projects are too slow. But you can see they're doing great. They're green all across, very consistent energy and infrastructure. And what we've seen is that ERCOT, which is the energy market out in Texas, is by far the number one energy market. And instead of plugging in, it's better for you to own the infrastructure and to own the energy, which is what a lot of the biggest master plan communities are doing in Florida. So if I was to pick the best performer of this group, it seems like, let's go to Skylines one more. Let's see how they have done. Skyline has underperformed compared to their competitors. So what makes it where Skyline does worse, much worse than their competitor? Why aren't they beating them across the board? How would you explain Skyline then? Why isn't Skyline doing as well is the question. I think it's because they don't manufacture. Different cycle path. HUD code shipments spiked and then fell hard. Sky rode the surge earlier and then took a big hit during the volume. The 3 year window you're looking at captures more of Sky's drawdown from the slump, while Cavco's rebuild leg has been stronger and more recent. Mix and operating. Sky's footprint is large and more volume sensitive. When shipments slow, factory utilization drops and fixed costs bite, compressing margins. Cavco managed the down cycle with tight factory loading, price, and that. I would say it's where their factories are. Factories are going to drive shipments, and Cavco has the largest position in manufacturing in Texas. Pricing power and vertical capture. Cavco's vertical stack expanded meaningfully with retail and financing channels, letting it keep more gross margin. Sky has expanded retail, but Cavco's recent moves created clearer compounder balance sheet and capital returns. Cavco ran with very low leverage, steady free cash, and consistent buybacks, which magnify earnings per share through cycles. Sky has ample cash and solid balance sheet, but Cavco's capital return cadence has been bigger. So proper debt management. Valuation. Sky commanded a premium during the 2021 to 2022 boom. Do both manufacture? But the scale, integration path, and strategic focus differ. Cavco manufactures HUD code manufactured homes and modular homes under brands like Cavco Homes, Fleetwood, Palmyra, and Fairmont. Operates 20 factories across the U.S. plus retail sales centers and financing. Cavco also has vertical integration is deep. Design, production, distribution via retail and finance arms. The core business model is retail plus factory model. Roughly half of sales go through the company-owned outlets, half to independent dealers and community operators like Sun, UMH, and ELS. Recently added retail through American Homestar. Cavco is a premium compounder model, high control brand equity, direct-to-consumer reach, which is what we see. A lot of direct-to-consumer. Can I sell a mobile home to a consumer? There's a license that allows you to do that in Texas. That's called a retail license or a dealer license. It costs $900 and allows me to brand mine that we're after. And that will allow us to white label and be the manufacturer of record. So I can take Cavco and control the business model, but not have to invest in the factories. Skyline manufactures HUD and modular homes under Champion Homes Skyline. So Champion is probably a better one. Let's look at Champion. Oh, yep. So Champion, I guess they may be private now too. So is Champion private? I think would be the question. So Skyline manufactures them, operates 40 manufacturing. It's the largest pure play manufacturing built housing provider by volume. Sells wholesale to independent retailers, land lease communities, and builders. So they do not have the direct to consumer. So if you don't have the direct to consumer end or edge, you're not going to make it. Sells primarily wholesale. Scale plus wholesale, but they just expanded into retail by making a $300 million acquisition, which is what you see Clayton as well. Clayton has 9 brands, Berkshire has 9 brands direct to consumer across 10 states. Skyline has 5-year return, 3-year return. The profit margins, they're almost equivalent. I see here. Revenue, return on equity, quick contrast. Both companies physically manufacture homes, but Cavco builds fewer high-margin units and monetizes more of the value chain. What about positions? Like by factory and sale velocity, direct to consumer. So this is one of the things that we're focusing on, which is proximity to manufacturing and mobile homes. If you looked at 5,000 homes. Cavco's business model, they design and build homes, then distribute via network. No, where their factories are. No, where their factories are located. If you look at where the mobile home market is the largest in the industry reports, there's 18,000 mobile homes in Texas. It's more than the top 3 states combined. We were trying to do deals in Florida, but there's not a lot of jobs in Florida compared to Texas. who has the most in Texas. So if you look at who has the most in Texas, Cavco, I think, has at least 5 plants. They actually have more than that. Skyline is announced a 2-plant campus in Texas. Did not find of all of them, given their national scale. Cavco has at least 2, and they have at least 1. Cavco appears to have more manufacturing presence. So the reason that I believe that they're doing better is because they picked the right market. And if you actually look at manufacturing facilities, USA, mobile home or manufactured homes. If you look at this, this is the list of where they're based out of. And if we feed this here, and we say who has the most, Texas has 27. Skyline has 5. Wow, that's surprising. Champion Athens, Champion Cavco. Clayton has 6. Texas plants. Legacy. Clayton, what it means. Texas is the national manufacturing capital of HUD homes. 27 plants, 18% of all U.S. capacity. Clayton dominates, but Skyline has the widest. So why can't Skyline make money? So why can't Skyline keep up then? Although when you were side by side, should be minting cash. It says volume is not margin. The value capture, their business model is factory to dealer to consumer. 90% go through independent retailers who take the final markup, which is what we're going to do. Because there's 27 factories we can pull from, I get to decide who I sell, whose trailers I sell, and maybe I'll make them my own. I talked to a couple mobile home manufacturing companies that want to take a position in a new factory in Texas, and this is exactly what we were talking about. So Skyline is a throughput company, not a value capture, which is what we're after. How do we capture the most value in the entire process? Like including infrastructure and energy, which a lot of these guys aren't doing. 90% of shipments go through retailers. Their manufacturing margin, while dealers in capture financing and retail spreads. Cavco owns its stores and finance like you see in the other ones like Lennar. So if I was to talk to Lennar or DR Horton or any of these other companies, you can bet they would want to work with us on the types of positions or would write a big check for sure. Factory underutilization. Sky runs 45 factories more than anyone, but they don't utilization. So they're fall down. So as they grow, fixed cost, labor is another thing. So when you build one, you should have the production. So if your productions of some of these factories are 2,000, 3,000 homes a year, you want to build them in the right place and have the demand for that. So if you build your sales process first, which is what we're targeting, it's going to help you out, plus land. When demand softens, utilization dropped. Skyline's utilization was still below that. Each 5% cuts margin. In short, too many factories. Cavco simply throttles fewer and it's more efficient. Product mix margin. Skyline's price is heavily weighted to HUD entry-level homes, low ASP, high margin. Cavco's average is $99,000, which is the price of a lot coming out of 4-star, just to put it in perspective. You can never enter below that. We just looked at the reports yesterday, and in every single state, all 50, mobile homes are entering the market $200,000 less than the typical home. And there's more people that make $15 an hour than there are that make $50. The gap matters when material and labor costs rise. Cavco passes it to higher income buyers. Skyline competes in the low margin. Modular and park model lines, which carry high margins, are only 10%. Park model lines. No finance, no recurring. Skyline doesn't own a finance company or insurance arm. Buyers go through 21st Mortgage or Triad Financial or local banks. So we need a finance arm. Every finance unit generates years of interest income. Cavco's finance arm insurance affiliates, Country Place, add recurring fees. Sky earns a one-time factory margin. Cavco owns earnings plus financial yield. Dealer dependency and working capital drag. Independent hold inventory. Skyline extends credit, which is kind of how the old dealer model worked. And Skyline is out of Detroit. Surprise, surprise. So they're doing it the old way. Skyline shipments fall abruptly while overhead stays high. When dealers destock, Cavco owned retail model. Acquisition digestion. Skyline acquired Champion in 2018, creating massive scale but also complexity. Integrating 40 plants and ERPs. Plant rationalization, Topeka line closures, facility upgrades, drags. Scale doubled overnight but synergies. Capital allocation. Cavco aggressively buys back stock and compounds earnings per share. Skyline retains cash to fund growth and capex. Good for long-term capability, bad for near-term TSR optics. Free fiscal year that free cash flow conversion, 60% of net income compared to 90% for Cavco. Numbers snapshot. Now, when they're side by side, I would say they're pretty good, but something is driving the returns of Cavco to be higher. Skyline, $2.56 billion, net margin 8%, return on equity 14%, debt to equity 8%, free cash flows and net are 60%, Cavco's 90%, and this is what we're after. Free cash flow, don't own the factories. 3-year TSR, 40%, 42% versus 170. Direct to consumer, less than 10% and worth 35%. I have some of the search volumes right here for mobile homes, and you guys can see the clicks. This is what I do every day for media. Mobile home, 500,000 searches a month. Mobile homes for sale, 500,000 searches a month. Clayton homes, 500,000 searches a month. Manufactured home, 500,000 searches a month. Mobile homes for sale near me, 500,000 searches a month. Manufactured homes for sale near me, 500,000 searches a month, up 900%. Trailer homes for sale near me, which I have no idea, 500,000 searches, 900% growth in the trailing 12 months. That's actually the 3-month moving average. House trailers for sale near me, 500,000 searches a month, 900% increase in 3 months. Mobile house for sale near me, 500,000 searches a month, 900% growth in 3 months. You see this. These account for over 4 million searches a month. The average is 500,000, and the clicks are nothing. The clicks are nothing. So if you're advertising a direct-to-consumer funnel, we run media companies. We're in the #1 market for online direct-to-consumer advertising. No one's going to be able to compete with us because we live in the heart of it. Companies like WAP and some of the other ones that go public, they're not doing this. You can see trailer homes, modular homes, all of these. There's millions and millions of search volumes looking for these. They go on forever. And this is just one data pull from a couple days ago. That's 8 million searches for a mobile home a month compared to luxury homes, right? So where do you enter the market? You enter the market where there's volume, which is what we're after. If I have to convince someone why it's the right time to invest, they're probably just not the right fit. The structural summary. Constraint. Dealer-heavy model. The effect on profitability is low margin and high volatility. If you have factory overcapacity, poor absorption when volumes dip. No finance and insurance arms. Missing recurring income streams. Cheaper product mix. Weaker pricing power. Integration overhead. Bloated SG&A. Cautious capital returns, slower earnings per share compounding. In one sentence, Skyline Champion is optimized for volume, but not for value. They move more homes, but most of the economics leak to dealers, financiers, and fixed overhead before reaching shareholders. They should be looking inward, not outward. How would you beat Cavco? If I wanted to be more efficient than Cavco, who is the #1 company that we just looked at, that's the billion-dollar play. Right now, Cavco is a premium compounder. It wins because it's vertically integrated. If you want to beat it, you don't out-manufacture them. You out-integrate and out-distribute. Cavco's advantage is its blind spots. They're efficient plants and solid cost control. Hidden weaknesses is fixed geographic footprint, which is the West and South heavy. I disagree on that because I think you want to be where people are buying. Own retail centers. They own Palm Harbor, American Homestar. Fragmented retail ops, not fully monetized or data-driven, which is our approach. Finance arm, country place and insurance. Finance penetration is still less than 50% of retail volume. Brand trust in modular and HUD homes. Weak digital funnel and poor consumer acquisition structure. You don't see people searching their name 500,000 times a month, unfortunately. Even 50,000 times a month. No one is searching for their homes. They don't have a consumer. You see Clayton manufactured homes still has more. Clayton has Clayton modular homes. People know who Clayton is. Clayton mobile homes. So I can use that against them in a digital sales funnel. Clayton mobile home alternative. Get double wides for half the price. Something like that would be a strategic positioning that allows me to capture that in the digital age. What else is it saying here? Brand trust in modular and HUD homes, weak digital funnel, and poor consumer acquisition cost structure, which is what we would win in. Because I'm 33 years old and I know what I'm doing, and we have a data team. I have quant modeling. We use AI integrated scrapers. We use prop tech that's internal that we would never sell unless someone takes a big position in our firm. Capital discipline and buybacks. Slow innovation and conservative tech adaptation, which is where we win. We see that across the board. Cavco wins on stability, not speed. It's a solid industrial. The playbook. Become a housing as a service platform, not a manufacturer. Cavco still acts like a product company. You act as the platform. Build vertically integrated around lead generation, finance, site acquisition, and move-in automation. Think Tesla meets Clayton. Tesla is now in electricity as well. If I go solar system, Austin, Texas, you're going to see who's number one. Axis Solar. It was some of the other ones too. Texas Solar. Yeah, I don't see them, but you see a lot of those companies coming in like that. Become housing as a service. Yep. Factory, retail, finance, setup, warranty, refi, trade in. Now you can't trade in, but we'll buy your own trailers in 20 years and sell you a new one. Bundle all of it, or we'll take those and sell them to the right people. So if you come up with a plan, digitally integrate sales, the Zillow of manufacturer. Cavco's digital sales experience is archaic. Build an online configurer where customers can design, finance, and schedule delivery directly. That's direct to consumer. Tie the CRM that matches leads to the nearest dealer, finance pre-approval instantly with soft credit pulls. We're seeing the same thing with like credit rebuild, and also have a credit rebuild arm. That's easy. That would cut cost per acquisition by 70% and double close rates. Cavco doesn't even track close rates, I'm sure. Acquire or partner with independent retailers. This is what we want to do. We want to become a partner and create a franchise. There are 2,000 independent manufactured housing retailers. Most are small, undercapitalized, and tech poor. We want to start in the position in the right place and become that. Think eXp Realty or some of the other digital first ones that have come. Roll them up under a unified CRM and marketing system with shared financing. So the tech arm is what we're looking for. Build a fintech arm that finances and services. Cavco's Country Place Mortgage is conservative. You could launch your own tech-driven credit model for gig economy buyers, rent-to-owns, or workforce housing segments. Partner with community banks and warehouse lines. That's right. To service those loans and package them up and sell them. Every $100 million of originating loans is $10 to $15 million of annual spread income. That's where the real money is. Modernize products and logistics. Invest in modular HUD hybrids. Higher price points, lower logistics. Build near rail and port corridors. That's exactly where we're after, which is Houston, right? Where we can bring those in. Leverage prefab shells or BTR operators. I disagree with that. Leverage brand and content. Cavco has zero consumer-facing identity. You could position it as America's housing rebuilt. You could say American mobile homes or American manufactured homes or Texas manufactured homes. Think like the big guys, you know. Workforce housing deals tied to industrial employers. Bundle home and energy and production. Financial strategy. Gross margins, net margin, return on equity, upside multiple, and customer LTV. Lifetime value is what we focus on in digital advertising and marketing, which is why I own a media company, and this is what we focus on is lifetime value. Pushing lifetime value. The simplest way to phrase it, Cavco builds, you build customers. How about no factories? You'd pivot from manufacturing to control of demand, distribution, and finance. Own the front end, the digital marketplace. Become the Zillow and Carvana of manufactured housing. Aggregate every brand's inventory. Cavco, Skyline, Legacy, Jessup. Lead flow. Control the buyer pipeline via SEO, TikTok, and geo-targeted find a home near you funnels, which is exactly right. Put $5 million to a digital prop tech that helps you capture the emerging and explosive manufactured. Retail franchise network. Partner with independent dealers. Rebrand them under a national brand. So you could say America's Mobile Homes, America's Manufactured Homes Direct, right? There's nothing bigger than America. Cavco can't do this because it would alienate its independent retail partners. Control the money embedded finance. Launch a housing finance platform that underwrites loans. So if I'm a fintech platform for manufactured housing, that's exactly what the industry is missing. Partner with land lease communities, RE parks, and BTR operators. That's what we're trying to do. Except build them. The only way to enter the market is to build them. Offer move-in ready packages. That's exactly right. Hop the wait list if you move into one of our parks and get a home in 4 weeks. That's exactly what people want. You become the distribution entities those factories rely on. If they're all selling, if there's 1,500 homes a month and I'm placing and I create the ability for 100 homes to be created, I can absorb 8% and sell only my own homes. Be the API layer, aggregate manufacturer feeds, specs, pricing, lead times, and shipping. We did this for residential housing on the entry level, but we still couldn't compete because of the land, how much land costs. So we got out of Florida, and we're targeting Texas and other parts like North Florida. Okay. Think Stripe for housing. Position yourself as the market maker. Buy distressed and cancel factory orders, resell them, arbitrage lag times. Your role, digital aggregator, embedded fintech, logistics network, industry API, and optional. And one says you beat Cavco by owning the customer and capital stack, not the factory. Cavco's moat is vertical integration inside its own plants. Ours is horizontal integration across every factory in the industry, a platform that every builder needs. And what you see, positioning it. So overall, guys, to sum it up across the board on HLP, and that's why I make these videos, because they're amazing for clipping and they're great for long form 15,000 word articles and proving that I know what I'm talking about. It comes back to read the reports and decide. And so for us, our target is Texas, and it's really the very low friction. And we have a deal in Henderson, 100 acres for $995,000 that we really like. You're going to need to be a part of a land entitlement arm. The average position that some of these larger firms are taking is around 20 to 50 million per deal, like an extended stay. So we will become this. And our target right now, Texas, when we say Gulf Coast Equity Fund, it just means we focus on the states that are on the Gulf Coast because of the blue collar and manufacturing heavy nature of them. Same with why I started Midwest Residential Growth Fund, which is our not a trade name, is the actual Delaware entity. Texas, within the map, our focus, we were looking over here, but at Conroe, these are pulling back, but a lot of the shipments are now going to the south side of Austin. Down here, there's a lot going in down here. So if you were to position it, we don't need to position a factory anywhere, but if I had to put one, it would be inside of the Texas Triangle, right in here. You have more access down here on I-10, which is what we've always talked about. That's why we call it the Gulf Coast Equity Fund. You have a lot of problems with flooding. You see all the water and other things. So we wanted to be more inland when we looked at Dallas and Tyler. How fast is Tyler, Texas growing? You know, you can't really control net migrations, but you can bring a lot of manufacturing. It's tough to sell, but we're looking at this area right in here, which is Maybank. There's already communities here. There's lots of lakes. It's almost like Orlando. It's great for destinations. So between Dallas and Waco, our focus is Central Texas, right in here. And our focus is on states that have very low regulatory and zoning friction. Texas is pretty open, but if you read county zoning and city zoning, the only place that it makes sense for us right now are two counties. And one of them is Henderson, where Tyler sits. It's actually, I don't think Tyler sits in it. Ours is right in here because they're not populated enough, and to actually count under, that would give them the ability to push back on a mobile home community. And the upside, the cost to entitle is not $500,000 like a typical, like it costs for a single family home community. It's much lower. It costs, my guess would be under 50,000, and you would be turnkey ready to go in 50 to 60 days. So I'll review that on another one, but today's was all about the benchmarking and describing who we are. So I guess from the analysis, I would say that we are the best person that I could describe would be a combination of Skyline, not Skyline. Let's look back at the benchmark reports. If I could say, who are you in a shell, it would be Sun Communities, which is they're set up to start doing development, and Cavco. If you combine these two companies in a 30-second elevator pitch, let's see how would you describe the combination of these two companies in 60 seconds? Or now I talk at 200 words a minute, 150 words or less. Sun Communities, SUI, and Cavco Industries, CVCO, together represent the full manufactured housing value chain from factory floor to finished community. Sun, a $22 billion enterprise REIT, owns and operates manufactured homes, RV, and marina properties across North America, monetizing long-term land leases and FFO growth. Cavco, one of the big three producers of factory-built homes, runs a capital-light net cash manufacturing model, supplying units to both retail dealers and community operators. Blending Sun's real estate footprint with Cavco's production capacity creates a vertically integrated ecosystem. Cavco builds the homes, Sun installs and operates them. They don't own them. The synergy aligns with stable asset-backed cash flows with scalable, unlevered manufacturing returns, hedging interest rate risk and supply bottlenecks while capturing end-to-end margin from construction to community rent. In effect, it's the Berkshire-style pairing of housing infrastructure and production efficiency, a durable platform for affordable housing growth across the U.S. Sunbelt. And if you add in the land development, the missing piece for both, in 30 seconds, how would you describe why someone would work with Horizontal Land Partners and Gulf Coast Equity Fund? So what are those companies missing that we have? Horizontal Land Partners and Gulf Coast Equity Fund bridge the missing middle between factory-built manufacturing and institutional operations, the land itself. We source, entitle, and develop essential land across the Gulf Coast, creating ready-to-build pads for manufacturers like Cavco and operators like Sun Communities. By controlling land velocity, infrastructure, and zoning, we de-risk supply, compress build timeframes, and unlock institutional yield in the most affordable high-demand corridor in America. In short, we're the connective tissue, turning raw land into stabilized income-producing communities where manufacturers, REITs, and investors can all scale together. And if we are all three, what is the new 200-word play of describing who we are? Here we go. Here's a 200-word positioning statement combining all three verticals. The REIT, Sun style, the manufacturer, Cavco style, and the developer. And I would say the land developer, which is HLP and Gulf Coast Equity Fund. HLP was what I started 6 months ago. We did a lot of advisory, but Gulf Coast Equity Fund is the combination of all three. Horizontal Land Partners and Gulf Coast Equity Fund form an integrated platform that connects land, housing, and operations across the most affordable high-growth corridor in America, the Gulf Coast and Southeast. We combine three historically separate worlds: factory-built manufacturing, which is precision-engineered homes produced efficiently at scale; land development, shovel-ready, utility-served sites that unlock velocity and control entitlement risk with community ownership and operations; institutional-grade REIT assets, delivering recurring yield through stable occupancy. Together, we control the full life cycle from raw land to stabilized income, bridging the gap between builders and operators. Our vertically aligned model eliminates fragmentation, stabilizes supply chains, and compounds returns across every stage of the housing stack. By pairing developer margins with REIT-style cash flow and manufacturing efficiency, we create the next generation of capital-light essential housing infrastructure. The enduring intersection of affordability, scalability, and institutional performance. In short, we own the land, build the homes, and operate the communities, a complete ecosystem for long-term value creation and sustainable growth. And if we say we do that in the Texas Triangle, and Texas, the number one market, does that increase or make it better? Of course it does. Adding that you operate in the Texas Triangle region, Dallas, Houston, San Antonio, and Austin, that is Texas's number one manufactured housing market in the U.S., makes this story significantly stronger. So here's the last play on that. Who we are. Horizontal Land Partners in the Gulf Coast Equity Fund are an integrated land, housing, and operations platform focused on the Texas Triangle, America's number one manufactured housing market and the economic center of Gulf Coast Corridor. We combine three verticals that rarely exist under one roof. Factory-built manufacturing, precision-engineered homes delivering at scale for affordability and speed, land development, which is entitled infrastructure-ready pads that transform raw acreage into productive housing sites with community ownership and operation, stabilized mobile home and RV assets generating long-term inflation hedge cash flows. By controlling land, manufacturing, and operations, we eliminate fragmentations, compress timelines, and capture full cycle margins from construction to occupancy. Our capital light model compounds returns across every stage of the value chain, turning underutilized land into income producing community. In Texas, where population and job growth are accelerating faster than housing supply, our vertically integrated approach creates a defensible moat. We own the land, build the homes, and operate communities, driving institutional scale yield and sustainable growth in the nation's most dynamic housing market. And that's it. So if you want to do business with that kind of firm and you're accredited, I would love to speak to you further. It's a long time coming. I had 2 great investor calls today. I've been in this industry for 11 years and I've gotten every accolade and everything that's written out there. I bought franchises from We Buy Ugly Houses in Texas. I sold and transacted more than 100 to 200 properties on my own. Every kind of asset class. I did condo conversions ground up. I did national development and conversions where we had some of the biggest, and I got to work for the largest firms across the board. But one thing was the same, that the biggest value capture is owning all three. Just like McDonald's has done, just like any gas station has done, just like some of the largest firms have done, where housing, logistics, manufacturing, gas, all of them come together. So we're really excited for this, and we're going to be clipping up parts of this long form video, but this is Gulf Coast Equity Fund in 90 minutes. Thank you so much for watching.